Student, this is second lecture of leasing, and in this lecture we will understand some fundamental concepts which will help you to understand the leasing concept much better. The one concept which is related to leasing is sales and leaseback concept. The second, operating or capital lease, and the third, that what are the fundamental difference between uh, operating and capital lease when you are recording it in your business transactions. Sale and lease back, if you have to understand it much better, for example, you need some financial support, and the one option which is possible in market, that whatever asset you already have, you sell it and then take it back on lease. When you sell it, so naturally the cash inflow will come to the firm, and then you will negotiate with any financial firm who will provide you the financial support for this one, and then you will take it back on lease. So this is an arrangement in which you sell your land, building, or any equipment, and then you take it back after for a specific period in certain terms and conditions which are attached with this type of sale and leaseback agreement. Suppose you have a plant and its total value is 5 million and you need a fund. So this is not practically possible for you to sell the plant and then use it for other purposes, because you also need plant. So what you will do, you will sell it to any financial firm who will provide you back. And in that case, this type of contract will be taken as a sale and leaseback, and then you will use it for a certain time period. In this case, the lessee, remember that now I'm not explaining what is the concept behind lessee or lessor, because we have already discussed this in the first lecture. So lessee receive cash from the sale of the asset. So you are selling equipment, you will take cash, and the lessee continues to use the asset, but still you are using this plant for your business purposes. And in this case, the lessee may have the option to repurchase the leased asset at the end of the lease. It means that another option which is possible for you, that after 2, 3, or 5 years, whatever term you set in this contract, you can take it back and put it back into your asset class. Operating or capital lease, as I discussed in the first lecture, which was related to leasing. But over here, I'm giving you some fundamental concepts which are required as per the International Accounting Standard when we decide whether this asset should be classified as an operating lease, or this asset or usage should be taken as capital lease. So generally, you will keep it in mind that if an asset is meeting these 4 criteria, then the asset will be taken as capital lease, or otherwise it will may be taken as a operating lease. The first concept which is related to this, and which must be met by the lease agreement, the lease transfer ownership of the property to the lessee by the end of the term of the lease. It means that if in the contract it is mentioned that at the end of the contract period the property will be transferred to the lessee, then this type of lease is called as capital lease. The second concept which is important is that the lessee can purchase the asset at a price below fair market value when the lease expires. Let's suppose um, a plant you are taking on lease, and at the end of the lease term, the value of the item is 5 lakh, but you can get it at, let's say, 25,000 or 30,000 or 50,000, which is very far below the current market value of that asset. Then this situation is called that you are working in capital lease rather than in operating lease. The lease term is 75% or more of the estimated economic life of the asset. Let's say the total estimated life of a plant is 5 years and you are technically using it for 4 years. So this 4 years may be translated as 75% of the lease term that you will use. So in this type of situation, we generally assume that this asset is taken as a capital lease. And the last concept is also important, that the present value of the lease payment is at least 90% of the fair market value of the asset at the start of the lease. 90% means, let's say you are taking a plant or machinery, the total value of that item is 1 million, and you are making a contractual agreement at a price of 9 lakh. 9 lakh is translated as 90% of the asset value. Then this type of lease agreement in which you will pay these lease payments on installment basis is taken as a capital lease. All these four criteria are important for you to understand the capital lease. Remember that if any one or two is meeting, then it cannot be taken as operating lease. And secondly, this is important for your uh, quizzes, as well as in a scenario based question where you have to decide at initial stage that the situation given should be taken as operating lease or capital lease. In accounting term, when we say that it is an operating lease, it means that we are not recording any asset in our business. We simply pay rent for this services that you are taking. And as you know, that in accounts we record rent as an operating expense. But in case of financial lease, the asset is shown as a non-current asset, and the present value of the lease payment, whatever, as we discussed in the previous slide, that it should be around 90% of the asset value, is shown as a liability in the balance sheet. So when you call it capital lease or when you call it financial lease, it means that asset will be reported in the balance sheet, as well as its present obligation or its liability should also be reported in the balance sheet. While in case of operating lease, neither we record any asset or nor we record any liability in our balance sheet.